Imagine this, it's the mid to late 2010s, and China's once booming peer-to-peer, P2P, online lending industry is in freefall. What started as a fintech wildfire, peaking with over 6,000 platforms in 2015, had turned into a nightmare of scandals, Ponzi schemes, and runaway risks. The infamous Azubao fraud in 2016 alone swindled billions from nearly 1 million investors, exposing the sector's rot. Beijing responded with a brutal crackdown, strict regulations in 2016, caps on interest rates, bans on aggressive debt collection tactics like public shaming or harassment, and a directive by 2019 giving remaining platforms just 2 years to wind down operations. By late 2020, the industry was effectively dead, 0 operational P2P lenders left. Profits evaporated overnight, and thousands of Chinese lending firms were left scrambling for survival. Their gaze shifted southeast, to India, a nation of 1.3 billion people where smartphones were proliferating at breakneck speed, hundreds of millions added in just a few years, digital payments were exploding thanks to initiatives like UPI, Unified Payments Interface, but traditional banking reached only a fraction of the population. Most Indians, especially in rural areas or low-income brackets, had no formal credit history, little financial literacy, and faced emergencies like medical bills or weddings with few options beyond moneylenders charging exorbitant rates. Regulations for digital lending? Lax at best. No comprehensive framework governed instant loan apps, data privacy was patchy, and enforcement was minimal. To these Chinese operators, India looked like the promised land, a vast, untapped ocean teeming with desperate borrowers hungry for quick, no questions asked cash. Loans of a few thousand rupees disbursed in minutes via apps, often with minimal documentation. They flooded the market starting around 2017 to 2019, many setting up shell companies in India with local fronts while control remained in Chinese hands. Apps like CashTM, Buddy Loan, and hundreds of others proliferated on Google Play, promising instant loans with sky-high effective interest rates, sometimes over 100% annualized, hidden behind short tenures and fees. The playbook was already well-tuned in China and ruthless: approve loans rapidly to hook borrowers, then unleash hell on recovery. Miss a payment, even by days, and the harassment began. Agents, often operating from call centers in India or abroad, would bombard borrowers and their contacts with calls and messages. Worse, many apps demanded access to phone contacts, photos, and gallery upon installation. Defaulters faced morphed explicit images of themselves circulated to family and friends, threats of public shaming on social media, or fake legal notices. Blackmail became the norm: pay up, or we'll tell your boss you're a fraud, or we'll send these edited nude photos to everyone in your contacts. But then reality hit like a brick wall, shattering the illusion of easy profits. From the very first repayment cycles, often just 7 to 14 days after disbursement, defaults skyrocketed. Reports from the era suggest recovery rates plummeted to as low as 30 to 40% in some cases, with non-performing loans ballooning to 60 to 80% or more for these predatory operators. Borrowers, many from low-income groups with unstable jobs, simply vanished, switching off phones, deleting the apps, changing SIM cards, or moving addresses without a trace. Call centers in India, often staffed by locals under Chinese oversight, would dial relentlessly, only to hear dead tones or be blocked outright. Some borrowers didn't even feign repayment. When agents called, responses ranged from outright defiance: "What loan? I never borrowed anything," to brazen mockery: "It was just a small amount, consider it a gift," or "Sue me if you can." Fraud was rampant too, people using fake IDs, stolen documents, or multiple accounts to grab quick cash with no intent to repay. The app's lax approval process, approving 95% of applicants versus the 5% typical for legitimate lenders, fueled this: no proper KYC, minimal verification, just instant gratification. Why so little fear? In China, widespread Sybil-like scoring made defaulting a life ruiner, blacklisting from loans, travel, jobs. But in India circa 2020, formal credit history penetration was abysmal. Only about 10 to 20% of adults had a credit score, concentrated in urban areas. For the vast majority, rural folks, daily wagers, first-time borrowers, these loans carried no long-term sting. No ruined credit meant no barrier to future banking. It felt like free money from a faceless app, not a binding obligation. Many saw it as a one-off windfall in desperate times, especially during the COVID lockdowns when jobs vanished. When digital harassment kicked in, bombarding contacts with abusive messages, morphed nude photos, threats of exposing borrowers as frauds or prostitutes, the backlash was fierce. Borrowers fought back, filing police complaints en masse, sharing screenshots on social media to expose the apps, or simply ignoring the noise. Some even counter-threatened agents or reported them for extortion. The real shock came when operators tried importing another trick from China's playbook, dispatching physical recovery agents to doors. In urban slums or call center hubs like Bengaluru and Hyderabad, this sometimes worked through intimidation. But in rural villages, the heartland of many borrowers, it backfired spectacularly. Agents, often low-paid locals hired for the dirty work, would show up demanding payment, flashing fake legal notices or threatening police action. Locals responded with raw defiance, mobs gathering to chase them away with sticks, stones, or brooms. In some anecdotal reports from police cases, agents were roughed up, their vehicles damaged, or even threatened with dunking in nearby ponds or rivers as a humiliating warning. This wasn't random violence but a cultural pushback, communities protecting their own against outsiders seen as predatory moneylenders. In India, traditional usury has a long, resented history. Villagers viewed these agents as modern-day sahukars, exploitative lenders, and weren't about to roll over. Police often sided with locals or dismissed complaints from the apps, seeing them as unregulated sharks. A few agents faced assault charges themselves, deterring others. Legal routes proved an utter disaster, a slow-motion train wreck in India's overburdened judicial system. Lenders, desperate to recover even a fraction of their disbursed funds, tried filing civil suits or sending legal notices under Section 138 of the Negotiable Instruments Act for check bounces, or equivalents for digital transactions. But these efforts crumbled. Court notices, often mailed to bogus addresses provided during sign-up, were ignored or never delivered. Borrowers had used fake IDs, rented phones, or temporary details, making service of process nearly impossible. Even when notices reached someone, recipients tossed them aside. India's courts are clogged with millions of pending cases, and small-ticket recoveries, 5,000 to 20,000 Indian rupees loans, weren't worth the years-long litigation for either side. Emails fared no better. Many borrowers, especially in rural or low-income segments, rarely used email, had forgotten passwords to throw away accounts created just for the app or simply marked them as spam. Snail mail via registered post? Straight into the bin or returned undelivered, as addresses were fabricated or transient, like shared rentals. Police complaints for cheating under IPC sections were filed by some lenders, but law enforcement often prioritized borrower harassment cases over lender fraud claims, viewing the apps as the predators. When lenders escalated to extra-legal shaming, contacting family, friends, employers, or even distant contacts scraped from the phone's address book, the tactic boomeranged spectacularly. Agents would blast messages like, "Your relative is a defaulter and thief," or threaten to expose secrets. Instead of pressuring payment, it often sparked curiosity or solidarity. Replies poured in like, "How can I apply for this loan too?" or "Send me the app link." Whole neighborhoods or workplaces learned about the easy cash, leading to surges in downloads from the same circles. What the lenders intended as humiliation turned into viral marketing among the desperate. People shared battle-tested evasion guides, use virtual or secondary phone numbers, via apps or cheap SIMs, provide fake Aadhaar/PAN details, often bought cheaply online, enter bogus addresses, grant permissions only minimally, withdraw cash immediately upon disbursement, then delete the app, block numbers, and discard the SIM. Some went pro, creating forged KYC documents to scam the scammers, grabbing loans with zero intent, or ability, to repay. The numbers turned apocalyptic, exposing the model's fatal flaws. Default rates for these predatory instant loan apps soared to catastrophic levels, averaging around 47 to 60% across the sector, with many individual Chinese-backed platforms hitting 70 to 80% or higher in non-performing assets. Borrowers simply stopped paying en masse, treating the quick dispersals as windfalls rather than debts. In stark contrast, China's regulated P2P lending ecosystem, before its 2020 shutdown, had maintained default rates under 8 to 10% in its healthier phases, thanks to robust credit scoring and enforcement. Here, billions poured in from Chinese investors and operators. Estimates suggest hundreds of millions disbursed, only for half or more to evaporate into massive write-offs. Recovery was negligible, funds vanished into ghosted accounts, crypto wallets, or remitted abroad via Hawala and shell entities. India's authorities, initially caught off guard, mounted a ferocious counterattack. The Reserve Bank of India led the charge, starting with warnings in 2021, escalating to comprehensive guidelines on digital lending in September 2022. These mandated transparency, like key fact statements disclosing all costs upfront, banned predatory recovery practices, required borrower consent for data access, and pushed for fair interest rates, effectively capping exorbitant hidden fees that pushed effective rates over 100%. By 2023 to 2024, enforcement ramped up with hefty penalties for violations. The government, citing national security, data privacy risks, money laundering, and predatory exploitation, banned waves of apps, 94 lending apps in one 2023 sweep, part of broader blocks totaling over 200 to 400 Chinese-linked apps, including betting and others, by mid-decade, with additional crackdowns like 87 illegal lending apps blocked in late 2025. The Enforcement Directorate delivered hammer blows through raids on offices in cities like Bengaluru, Gurugram, and Hyderabad, freezing hundreds of millions. Chinese nationals were arrested in multiple operations, charged with money laundering, extortion, and operating controlled networks. Culminating the cleanup, in 2025 the Reserve Bank of India issued Consolidated Digital Lending Directions, a unified, stricter framework superseding earlier guidelines. It expanded oversight to all India financial institutions, mandated local data storage, enforced registries for lending service providers, introduced whitelists for compliant entities, and obliterated gray areas with requirements for first loss default guarantees, grievance redressal, and algorithmic transparency. Non-compliant players were squeezed out entirely. At the root of this epic collapse lay a profound cultural chasm the Chinese operators fatally underestimated. Their homeland model had flourished on a bedrock of fear, deep social stigma around debt, losing face, the looming threat of bad credit score and blacklisting, barring travel, jobs, education, and tacit tolerance for aggressive tactics like public shaming or doorstep visits, backed by a system where compliance was near mandatory to avoid lifelong ruin. Debtors paid up, terrified of consequences. In India, that fear simply didn't land. No equivalent nationwide credit bureaucracy existed for most, credit bureau coverage was patchy, under 50% even by mid-2020s for the masses, so defaults carried little lasting sting. Threats via calls or messages. Easily blocked or ignored, often met with laughter or counter-abuse. Physical intimidation. As seen earlier, it provoked community backlash, agents chased away, sometimes roughed up, with locals applauding the resistance. Outsmarting the sharks became a badge of honor, sharing evasion tips in groups was celebrated as street-smart savvy, not shame. Defaulting on exploitative lenders evoked sympathy or cheers, he fooled the cheaters. Rooted in a cultural wariness of usury and a history of resisting predatory moneylending. Solidarity trumped stigma, victims turned into vocal crusaders, amplifying the rebellion online and in media. This resilience, fused with regulatory iron fists, turned the invaders' dream into a rout, billions lost, networks dismantled, and a hard lesson in why one-size-fits-all coercion crumbles against India's defiant spirit. The unregulated Wild West of digital lending was tamed, leaving only compliant players in a far safer arena. For the Chinese firms involved, this debacle delivered a brutal, costly lesson etched in billions of lost capital. You cannot simply copy-paste a business model rooted in coercion and fear into a vibrant democracy without institutional muscle to enforce it. In China, the ecosystem had thrived on a potent mix of social conformity, pervasive credit surveillance, and regulatory blind eyes to harsh tactics. Debtors paid because non-compliance meant tangible ruin. Transplant that to India, with its fragmented enforcement, vocal civil society, and absence of a nationwide fear apparatus, and the model imploded. Ignoring deep-seated cultural norms, where outwitting exploiters earns respect, not scorn, evolving laws, and the sheer resilience of people pushed to the edge proved catastrophic. Many operators fled or pivoted, licking wounds from irrecoverable loans, frozen assets, and shattered networks.